Hello, everybody. Welcome to another Talk Money with Tom show today. Really excited to have you with us today. This is a question and answer show, and our objective is to try to help you have a better retirement. Really, by the end of the show, if there's anybody out there that can say to themselves that they learned something that can help them, that would be a great success to us. We're big believers, as you can tell from this channel. We have 700 different videos on here now. That education around retirement planning, investment, asset management, and tax planning are really important to try to maximize the success of your financial portion of your retirement. And so that's what this show's about. We get questions that come in. You can send them in now if you'd like to this Ask Tom at talkmoneywithtom.com. You can put it into the chat. So we get questions during the week. We also bring up some subjects that came up as questions within our strategy sessions that we have with the clients. So Ethan's here with us today, and he'll be kind of the moderator asking the questions, and feel free to send them in as we go too. It's really kind of fun for us as far as that goes, and we'll go back and forth, answer these questions, and try to fill this subject out, and hopefully be able to help you. And again, if you're really interested in trying to extend your education, you might want to subscribe to the channel. There's a subscribe button there. You can hit the little bell. It'll notify you when we put something on the channel. Or you can just set up an appointment with us. There's a link to our website here on the channel. And at the top corner of the website is a book an appointment button. You can schedule a 30-minute phone call or video with Ethan and I, and we can discuss what might be able to help you, on a custom basis as far as that goes. So really looking forward to it. Look forward to being able to answer your questions today. I like to start off the show with just a summary of what I saw happening with the stock market. I consider the asset management portion of retirement to be one of the key areas for success. And so as much as possible, I'll try to educate you about what I see, and maybe that helps you going forward as far as that goes. And this week was really fascinating. We had a really good week going, all the way through Wednesday, big up days, markets moving very strongly, lots of green on the charts. And then the CPI number came out at 7.5% on the inflation. The expectation was 7.2 to 7.3. Again, the market kind of shrugged that off. It fell on Thursday morning and then, came back up. It was up in the green. And since then, we've had lots of down markets, including what's happening today. And the first catalyst was the situation where one of the Fed governors came out after the CPI number came out and said that he would be very aggressive on raising rates, looking at a 0.5 point increase in March and a full 1 point altogether by July. This is much higher than the market has expected, so there was a big adjustment to the downside after that. After hours, there were other, Fed governors that came out and said that they didn't agree with that they would be looking more at a 1/4 point cut and all of these things that are happening. And then today we were kind of moving along really on a little bit of a negative basis, but and then there was kind of an announcement that they felt that Russia, invasion of Ukraine might be imminent, even to happen before the end of the Olympics here, and the market has sold off on that as far as that goes. So I think one of the key things that I look at when I try to look at what's going on is really, how does this affect the economy? So how does the inflation situation affect the economy? How does the situation in Russia and Ukraine affect the economy? And the reason that's important is because, stock market downturns happen all the time. The average downturn without a recession for the S&P 500 is 15%. The average downturn with a recession is 36%. So I'm really much more concerned about the 36% down than the 15% down, because that's kind of a normal motion for the market as far as that goes. So if we look at what's going on right now, is this inflationary environment that we're in right now going to cause a recession? Is the situation in Russia and Ukraine going to cause a recession? In my opinion, right at the moment, is that the answer to that is no in both cases. That's possible longer term, but maybe not here this year or even early next year. And that's because if you look at what's going on, first of all, the economy is very hot. It's doing very well. leading indicators are doing fantastic. Earnings are up tremendously, 36% up in the third quarter, 29% up here that are being released right now for the fourth quarter results that came out at the end of last year. We're seeing really, really good things happen in terms of the earnings, which ultimately will be the driver of this scenario. And so it's hard to imagine, recession kicking in right away. So if we look at kind of just peel back the layers a little bit on inflation, what's happened with inflation is that we had a situation at the beginning of the pandemic where demand dropped more than supply, and we actually had lower inflation at the beginning, say spring and summer of 2020. And then demand started to pick up. Variety of reasons. People started feeling better, started getting back out more. A vaccine came out. There were several big stimulus bills, one that came out at the end of 2020 and one that came out at the beginning of 2021. And so people had money in their pockets, and we ended up with this big surge in demand, and supply couldn't keep up for a variety of reasons. One of the biggest of which is that people weren't coming out to take the jobs that they needed to kind of build up this supply chain again. And so supply is not keeping up with demand. It's outstripping, the supply. So that's an inflationary environment. It's also been exaggerated by the fact that people are buying more goods than services. So in other words, people feel more safe ordering goods on Amazon than going out to a restaurant or getting in an airplane or going and staying at a hotel. And so we're getting this, big amount of money that came out all being focused into a smaller area, and we're having a bigger inflationary impact on goods than services. So there's a whole bunch of things that can happen with inflation to make things better. Number one, we're probably going to see demand start to drop naturally just because a lot of these stimulus pieces are now burning off. We're hopefully, if the virus can settle down a bit, people will start moving around more and using some services instead of just goods. And we'll start to see more of an even spread of the money coming out into all of the different areas, which would slow down inflation. And then, of course, the Federal Reserve is going to be pushing on demand, right, with the rate increases and those types of things. And so that should hopefully start to lower demand, especially by the second half of this year. And then I'm a big believer that supply will continue to get better. And we saw the job numbers come out, so people are coming out for work at a higher rate, as we saw from last week. But more importantly, I just believe that companies, especially these great companies that we like, are able to kind of meet demand. They're really good at it. If you tell a company, hey, you can make more money if you go out and find a way to get the supply, they're going to try to do that. And so, American companies as a whole and even global companies around the world are really good at meeting supply demands. Not right away. It does take some time. There's a disconnect. Demand can turn on just like that. People can just open their wallets and start moving. Supply takes time to kind of build up that chain. But I do feel like by the second half of this year, we'll start to see better supply. And so the combination of those bring down demand, bring up supply. You end up with less inflation. And so the opportunity there is in the fact that the market is expecting massive inflation and huge number of rate cuts. We went on on Wednesday. There was the market expected a rate increase of 0.5% on March, 24% expectation. After the Fed governor's announcement on Thursday and the CPI number, it jumped to 99%. And look at the interviews with all the other Fed governors, none of them agree with that. So, once March's increase comes around, and if it's not 0.5%, we could see, a jump upward in the market. The expectation for total, rate increases is 5.5%. So far, that's continued to come up, and the Fed governors continue to come out and talk about 3 to 4. And if that happens, you'll have a motion upward. But ultimately, I do think that inflation gets under control at some point in time, and that's when we'll start to see the readjustment from this very negative outlook on inflation to something more reasonable, and that brings up the stock market. And so those are opportunities. If you look at the last 6 months, if you look at the Vanguard Total Stock Market Index, the one that I follow is VTI. It's a exchange traded fund. For the last 6 months, it's up that's down 0.02%. So basically zero. All right, so it's flat, but it was up 6.8 and down 4.7 at its peaks and its lows. And so when you get that type of sideways churning market, the best strategy to use is to rebalance the portfolio at those low points. And that's what we've been doing. And it's been working quite well as far as that goes. And, because if semiconductor index, for example, that I have in my portfolio, if it drops, because of some inflationary fear or a situation that could happen in Russia and Ukraine, I want to buy more of it, honestly, because there aren't that many semiconductor companies, and they're really, running flat out, and that demand seems to be continuing, and more products are using semiconductors, et cetera, et cetera. So I think it's a key area that people could make money on, for example. So you want to rebalance in this scenario. You also want to keep most of your money in very broad based indexes, just because you can't tell is it going to be energy and financials, because inflation does stay hot? Is it going to be growth type issues, large growth and what have you, technology that does better if inflation isn't as hot? So I can't tell you exactly what's going to happen there. And I don't think anybody can, because of the number of variables at play here. And so having a big chunk of broad based piece is important. If we look at Russia and Ukraine, every single time we have a geopolitical situation like this, an invasion, a different war, the stock market drops initially. And there's some concern there because oil is involved. And so we're seeing a spike in oil right now as as this information comes out. But historically, after that drop, things settle down and the markets come back. And so you got to take a look at the Russia-Ukraine situation and say to yourself, does that impact the economy to the point where we would have a recession? Unfortunately, in a lot of these conflicts, there's an awful lot of money being made and selling of weapons and different things along those lines, and it can sometimes be a stimulus to the economies. So we'll see how this plays out. I don't think it'll be a great thing. I do not think this is going to be a situation also that creates a recession, personally. So again, on those dips, as people kind of pull back based on the fear of this situation happening, that's a good point to buy. So these things could change, things could get worse, and then you want to be able to have more defensive situation for that. But in the interim, until proven otherwise, this is a sideways moving market where you should be basically rebalancing and trying to take advantage of these situations. So, when VTI was down 4.7%, if you're rebalancing there and it comes back to zero, you made money on those pieces that you bought, at that lower point in time. And that's how you can make money in a sideways motion market. Maybe not enough to really create huge rates of return, but what it's doing is it's setting you up. You're continuing to purchase good shares of good quality situations at lower prices. And then if the market ever does take off again, you're kind of raring to go, and you would benefit from that as far as that goes. And that's been my outlook. I think the first half of this year is going to be a lot like the last 6 months, and the second half of the year could be much better. So anyway, that's what's going on right now. Really interesting time frames, all kinds of different variables happening and throwing at us. And that's been very true for the last couple of years and doesn't seem to be changing now. But I look forward to seeing what's going to happen next week, and I'll obviously report that also. All right, Ethan, what do we have for questions?
So the first question is, can I have too much stock in my portfolio? Would this cause me to have a lower chance of success in the long run?
Yeah, so this is actually a question that came up in a strategy session with our clients. And this is really interesting. It revolves around the situation of, how much money should I have in stock for my particular retirement? And it's kind of fascinating. It doesn't always, translate to make sense. So I'm going to share my screen here, and we'll take a look at kind of an example I made. And so this is what we call finding a retirement path. This is all part of this whole component. We think this is super important. So education is part of that. But really, part of a retirement path is how much money should I have in stocks or bonds, throughout my retirement. And so it's kind of fascinating. Here's what I'm going to show you for an example. Very simple. This is a financial plan, lots of information behind the scenes. I'm going to give you the high level piece. So here's a portfolio, 58% stock. It got a bond and cash are the other two pieces in there. And the projected average rate of return on this is 7.7%. This is from Money Guide Pro's financial planning program. And so what we would do then with that particular mixture, we could run Monte Carlo simulation. And so I'm going to push this button here in just a second and basically, run their financial plan 1,000 times. So just to understand, behind the scenes, we have these assets, we have inflows, Social Security, and those types of things that'll be coming in someday. And then we have outflows for things that they need to have to live off of. And so when I push this button, it's going to run their financial plan 1,000 times and see how many times it works. And it allows the computer to randomly choose amongst the different variables. And it's supposed to replicate your life by running it enough times. Kind of the average is what you're looking at there. So once I go ahead and push this button, there we go. All right, so this is what you end up with, is this big, green spaghetti, so to speak. And so for this particular sample, we have 930 successes out of 1,000 different tries running through this Monte Carlo simulation. So that's a 93% success ratio, which is very good. Anything above 85%, in my opinion, is very, very good. And so at the 58% exposure to the stock market, this plan works quite well, right? So not bad at all as far as that goes. But just to show you kind of a difference and something I think is interesting, what if we, what if we move that same portfolio into a scenario where we know the stock market's going to fall, right? So this is what we call a stress test. So here we had a 93% success ratio, but if we run this again with one known variable, is that we're about to have a stock market crash. In this case, just like the Great Recession loss. If you remember, for the Great Recession loss, started in 2007 actually, but most people look at it as 2008. We ended up with a 57% drop in the S&P 500. The percentage loss for this portfolio is projected at 23%, but you can see their probability of success drops all the way back to 56%. So obviously a big stock market downturn is something to be concerned about in this particular situation, and we have strategies for what we would do with that. But I just want to compare that to a different mixture. So here now we're going to take that same plan and assign a much more aggressive portfolio. So here it's 96% stock. The other 4% is just money in the banks, basically. Average rate of return is expected to be 9.74%. So if you remember, the previous one was 7.77, so almost 2% more per year. Theoretically, that should work better, correct? But it doesn't. And so if I now click on this one, same parameters, I just changed the portfolio, it drops back from 93 to 89%. So even though there's a higher average rate of return, the success ratio dropped back by 4%. And the reason is because we just added more volatility to the overall portfolio. And when you run that through 1,000 times, there's going to be some of those times where the stock market just does so terribly that you end up with a situation of failure, where you can see these red ones across the bottom here. And that's when, basically the money ran out before you did, which is obviously not ideal. Still not bad at 89%. That's still higher than my threshold of 85, but it's not as optimal as the 58% portfolio where we had a 93%. And it's kind of exaggerated by the fact that if we run the stress test and reevaluate this thing with a Great Recession coming, we drop back to 13% success ratio, which is really, you're running out of money at that point. And that's why there's more red situations in there. And obviously you can see that, it has a 49% projected drop in the value of the portfolio. So that, again, lots of things happening behind the scenes and what have you, but that's a really critical component of what we're looking at as far as that goes. And so overall, I think it's important to, use this tool to try to figure out what we're going to do. And one of the biggest questions we get, and we're trying to answer that sort of here now, is how much, stock to use in the portfolio. And so what I do is I'll run that Monte Carlo simulation, 20% stock, 40, 60, 80, 100. And, usually I come up with a range. Like I say, okay, the optimum, success ratios for you in your situation seem to be 40 to 80% range, or 20 to 60% range, or whatever it might be. It's different for everybody. And even sometimes the higher, the 80 and 100% is optimal depending on your parameters. But what we're trying to point out here is that higher rates of return and higher risk don't always relate in every case to a higher probability of success throughout retirement, because there's just too many other things that can come into play there. So I think it's a great way to look at it. It's very interesting. But to answer that question, yeah, you have to be a little bit careful about, just adding more stock with the thought process of, hey, more stocks make more money, but they also have these big periods of time where they can make less. And if you're living off of them at that point in time, that could be a problem.
So what happens on the emotional side? Some people, you know, they can't handle, it just feels so slow, or like the returns are so low when they do 60/40, but because they're so used to the 100% model,
Yeah.
even though it lowers their success chance,
Yeah.
would you stick still at that 100% model? Would you maybe go in between the two? Is like, how do you balance that, like, emotional side versus that just the pure numbers?
Yeah, pure kind of analytics. It's a good point, Easton, because really what happens here is that the emotional side actually dominates the analytical side in the end. Because it's one of the things I learned about with the 2008 downturn. We can go through a planning process on an analytical side, say, hey, you should have 80% in the market. But then we have a big drop and people are selling out at the bottom because it really didn't meet their emotional needs in terms of how much risk you were taking. And you're exactly right. It can actually go the other way too, where you've got 40% exposure because that's what the model says you should have. And people are dissatisfied during a big upturn and they're constantly wanting to move up. And obviously, sometimes they move up at the wrong times, right? Right at the end of the big run. So, one of the things that we really look at there ever since 2008 is we really try to point out, what the average rate of return was on the upside, so you can see, hey, and then what you might have lost, on the downside. And we specifically will look at the 2008 downturn and kind of model that. So, somebody knows, hey, I might lose 30%. And I think they just need to be comfortable. It does help to know the range that's recommended by the plan. That's a piece of the puzzle. But in the end, it's really about the emotional side. So we try to grab the emotional side by showing kind of the extremes, how much it can make in a good market and how much it can lose in a bad market, and make sure that they're comfortable with that range. But in the end, emotional people throw the plan out the door when they're nervous, or what have you, as far as that goes. So I've seen more people having too much risk in their portfolio over the years than not enough. That doesn't come up as often. Usually it's a fear factor that comes in. And so anyway, that's a good question. It's a good point.
Yeah, and when we showed our charts, that Great Recession, like having that simulation is basically the worst case scenario you can't have for the stock market. It's essentially saying, I retire, I'm making no more income, and my assets, all my stock, half of my stock value disappears. And so, if you're in that situation in real life, maybe you take 6 months to continue working, or a year to
Yeah.
work, and then you just push out your retirement. So like, this is kind of planning, the worst of the worst.
Well, I guess the only thing I'd say is the Great Depression was worse. And I have clients that have pretty good exposure to that, through their families and what have you. Because the Depression was down 86% and took 14 years to recover, versus the Great Recession, was down 57%, took 5 years to recover. But you're right. I mean, it is. It's a bad case scenario and a bad timing scenario is what we're looking at. And so, if your numbers come out great in a bad timing scenario, boy, that's a really good sign. If your numbers don't come out great there, then you're a lot more susceptible to these big downturns, and you'd want to really think about, what type of portfolio you have, and even maybe what strategy you'd have to deal with that. So, I mean, part of it is maybe you have more cash buffer so that if the market drops, you could then, draw on that cash buffer for a while until it comes back, right? And allow your portfolios to grow. Again, this is assuming you're retired. If you're not retired, you should be adding. And when that great recession happens, it's horrible for your 401k, but keep adding, keep adding, keep adding, keep adding, because, eventually when that does you back around, you'll end up with more money than you don't. But if you are retired, you kind of want to do the opposite because you're having to sell more and more shares to get the same dollar amounts out as those share prices drop in value. So ideally, you'd have someplace else you could withdraw some or all of that money from for a period of time, as far as that goes. And so there's different strategies. Again, that would be determined partly by that stress testing. If you're at 99% after we do the stress test, then maybe it isn't as important to have the cash buffer. If you're at 56%, like we just saw, or 13%, then it's much more important. So yeah, I think that's a good point.
So our next question relates to like all the inflation. Some people talk about, investing in gold and silver when there's high inflation. What are your thoughts on these trends over time?
Yeah, I actually been asked that a lot. I've looked at it a lot. It comes up, there's a couple of ETFs that I pretty much constantly follow, GLD, which is for gold, and SLV, which is for silver. Um, and I'm constantly putting them in on a back testing basis and trying to see what happens in different scenarios. Uh, for me, the key criteria isn't so much fighting inflation, it is protecting my stock market portfolio. And one of the problems I've had with gold, specifically, and even silver for that matter, is that in these big downturns, like in 2008, they came down pretty heavily, versus say treasuries, which came down less. Or exact for look at 2020 here, treasuries went up quite nicely actually. So I'm a huge believer in the fact that we make money in two areas in our lives: our real estate and our stocks. And so I don't deal with the real estate much. That would be your own home or your rental properties or what have you. But the stocks I do. And so whatever percentage stocks that you have that works for you in our portfolio, I want to protect that. And so gold theoretically is a protection, but it has fallen quite heavily several times during some of these big downturns. Combine that recession with with a down stock market, and you end up with negative 36%, and gold isn't the best hedge there. It's working right now. I mean, I just said earlier in my summary that the total stock market index is essentially flat for the last 6 months. GLD is up 5.4%. So it's not a bad piece in this particular environment. And essentially, it's held up when the market came down. And I do like that, especially in this environment where bonds aren't holding up either. So I don't have a problem with it in the portfolio. I just don't normally add it because it's creating a higher level of volatility in that one component. And I'm not getting a big payoff to protect my stock portfolio. This is a downturn, but this isn't the downturn I'm concerned with. I'm concerned with the ones that are 20, 30, 40, 50%. Those are the ones that I really want to watch out for because those are the retirement killers, as we just discussed. Um, yeah, I think it's an interesting component. I have no problems with people that want to put it in. I have no problems with people that decide that they like that and we can add it to their portfolio. I have never actually had it in my portfolio at any point in time. The combination of volatility and the fact that it doesn't go up consistently in these big stock market downturns has kind of kept me away.
Yeah, and like even silver in this like last 6 months is actually negative,
Yeah,
like around -1%.
yeah,
So
yep,
so there's even a disconnect in other precious metals from each other.
yep,
So
yep.
it's hard to gauge if they're
Yeah,
useful.
consistently in these very big downturns, people do run for treasuries. They're not doing that right now because this isn't a big downturn. This is an inflation scare, these types of things. But I would say that if we had a recession here and the stock market was down 20, 30, 40%, I bet you would see some pop in treasuries. one of the problems with treasuries is that their rates of return are somewhat limited by the fact that the yield is so low. And it's come back up. The 10-year treasury is now 2%, and to get that back down to 0.5% like it was before, you would see a price increase, and that's the offsetting thing I'm looking for. So it's a little bit difficult to find these offsets in this particular environment. I'm just not sure that gold will be the place everybody's running to. Maybe this time. It hasn't been in the past, so that's one of my concerns. Yeah. Uh,
So another portfolio question is, should I be using dividend stocks to generate my income in retirement?
I like dividend stocks in this environment. They're doing quite well. If you take a look at some of these kind of high dividend ETFs, where they buy stocks that have got high dividends or consistently increasing dividends, there's all kinds of flavors of those. Those are all doing a lot better than the market. Not all, but obviously a majority are doing better than the market right now. And that's because when, interest rates come up, people are really looking for that dividend payer stock, especially because their bonds portfolios are getting hit right now. I think the total bond market index is down 4.5% so far this year, for example. And so dividends are starting to receive, stocks are starting to receive some of that money from bond players. So actually, I have just from a strategic standpoint or a targeted index standpoint, I think dividend stocks are a pretty interesting play right here, and I do like them. In terms of overall long term, looking at trying to generate your income out of dividend stocks, I'm not as a favor of that just because they are kind of cyclical. They go up and down and up and down. I'd rather have an overall balanced portfolio that I'm withdrawing from that can handle more of the different cycles because you got everything in there than trying to push so much of my money into dividend stocks in trying to generate this income because I could end up with a lot of valuation drop, which we've seen several times. And honestly, a lot of companies that pay high dividends do so because their stock isn't growing. And it's their way of kind of attracting people into there. And if they ever, God forbid, cut their dividend like AT&T is trying to do, the value could drop quite a bit. So you might be getting a 5% dividend and lose 5% on the price or more. And so that's why I'd be a little bit careful, as with anything. You don't want to put everything into one particular category. But from a targeted standpoint, adding it to a portfolio, yeah, I have no problem with that right now. I think it's a good idea.
So your point is when we have a portfolio, we shouldn't focus it for kind of just one thing. So like if we focus our portfolio just for dividends to generate income,
Yep.
we lose kind of our flexibility in handling different markets essentially.
Yeah, I've seen it before. I've seen portfolios come through. We do the analysis. It's all about high dividend paying stocks. And if you look at the long term rates of return on those, they're not as great as a broad based portfolio. Again, because they're cyclical, generally speaking, the overall growth isn't that great on the price. And yes, you're getting your dividend, but you're not getting any growth. I'd rather have the combination of, say, a smaller dividend and some growth. Long term, that's worked out pretty well. So just a difference in style. And I just feel like, any portfolio that's shoved into one corner can do great when that corner is in favor, but could have some real problems long term because there's nothing that stays in favor forever, it seems.
So our next question is a question that we've had a couple times during our meetings is what's the process for buying life insurance?
Oh, yeah. I mean, the first thing you have to do with life insurance is just figure out um, how much to buy. And so we use the estate planning portion of our financial plan, and we can go through and put in all the different parameters. And then it essentially spits out, hey, you should have $750,000 worth of insurance to make sure if something happens to you, that your beneficiaries could still achieve the goals that you've got, dealing with mortgage payments or dealing with college costs or whatever it might be as far as that goes. So that's kind of the first spot as far as, the process, figure out what you need. I found that that is the best way to do it. It's very difficult otherwise. So you're kind of guessing. Um, and then past that, it's a matter of, essentially going through the underwriting process. And you can talk more about that too. You've been dealing with that. So tell us, what that's kind of like for people.
Yeah, and so essentially, first we go and find you some quotes. So we'll try and find you what is the cheapest, and it depending on where you are, sometimes they're very similar or they can be different based on the riders. And so when we compare similar contracts, we'll try and go with the cheapest one, and then we'll go through the underwriting process where we are essentially trying to they essentially turn in an application, and sometimes there's medical records with that application, and they try and figure out what is their cost for you. And sometimes they'll give you similar to your quoted rate, and other times they'll maybe make it a little bit more expensive because your health was a little bit worse than what they quoted out. And at that time, you would then start to go from there by then you would sign off on that quote. And that's essentially how you get insurance. One caveat is when you're trying to figure out the insurance needs and you have someone that's in your a couple, maybe one of the spouses part-time or is a stay-at-home parent, then you have to also value in how much you're replacing of the work they put in, chauffeuring the children around, any kind of homework that they do or housework that they would do is, how much does it cost to replace that work? Because it's hard to be working and adding on someone else's stuff too.
Yeah, yeah, exactly. Yeah, it's quite fascinating. Especially for young families. It seems like it's a really popular area to make sure that things can still happen. I know for me personally, I didn't have life insurance until I had my first child, and I just felt a responsibility. I decided to have that child. I wanted to make sure, and I eventually had a second child, obviously, but wanted to make sure my children could be taken care of and that my wife could still do what she needs to do as much as possible. And so we went through that process, and we both ended up getting, life insurance policies to cover that particular need. So I do think it's an interesting area altogether, and it's something that certainly makes me feel better.
Yeah, and even if you don't have children, but you have a house, say a
Mm,
mortgage, you
yeah.
could then get like a decreasing term life insurance that would, follow how much that mortgage is.
Yep.
Because essentially, maybe without having both your incomes, you can't pay that house off
Yeah,
anymore.
that's right.
And so you want them to be able to still have that same quality of living.
Yeah, exactly. Exactly. Makes sense.
So this is a question that we get a lot as people get closer and closer to retirement. Does my retirement portfolio look any different than the one I have right now when I'm accumulating money?
Yeah, that does come up a lot. People are heading into retirement and they're like, well, will I be changing my portfolio because I'm going into retirement? And the answer to that, actually, in my experience, has been no, not very often, sometimes. Uh, Mainly because, the portfolios are generally driven by two things: what the financial plan says they need to have to accomplish their life all the way through, which is 90 to 100 years old, and so that, if that comes out at 60% or 40 or 50 or whatever it is percent stock, that from an analytical standpoint, we need to have that much. But more importantly, what we've found over the years is that people kind of settle into a certain mixture, and they are either happy or unhappy with that mixture. And if they're unhappy, they readjust, and eventually they get to a spot where they're happy. Within our practice, it's kind of fascinating. Over a 20-year period, we've been right around 60% stock. And that's not because I'm driving that. It's because that's a comfort point. People like that portfolio. Now, I have people at 100 and I have people at 10% stock, but just the average across the whole board is around 60. And so, it's a comfort level that continues. And so, changing that heading into retirement, um, I suppose if somebody had way more risk than they should have, I would recommend that they move down just because, again, they're now, not working and don't have that income. But most of the times they don't see that situation. You can change it, but oftentimes you'll find that the plan isn't requiring it. So then it just becomes a situation where, what's your comfort level? What do you really like? Some people are very aggressive. They like that and they're willing to handle the fluctuations. Other people are very conservative or in the middle. That doesn't change just because somebody retires.
Yeah, and you just have to remember, though you're starting retirement, your portfolio still has to last till your rest of your life, which could be another 20, 30, 40 plus years.
Yeah.
And so if you become too conservative, you could really, as you get older and older, have a higher chance of running out of money.
Yeah, that's right. Yeah, that's that's I've said this before, but the most difficult challenge of financial planning is longevity. And just making sure you have enough money for the long term because inflation does happen like we're seeing right now. Usually isn't this high, but it does happen and things cost more and more, and the same things you're doing now will cost more at some point, and it just sort of creeps up on you. So got to make sure that you have enough money to keep that rolling, and that's part of that plan. So yeah, it's generally speaking, I don't see tremendous changes heading through retirement. I'll see changes more having to do with what's going on with the market or just people's overall scenario. I have seen changes within couples where specifically the cases I'm thinking of, it was the man in the relationship was very aggressive and the woman was not, but she allowed him to do what he was doing. It was his main job. And then when he passes away, she'll talk to me and says, I'm not that aggressive. And so we'll move that back down to kind of match her tolerance. And so, there's sometimes that happens within a couple, and there's nothing wrong with that at all. Just those where sometimes we see adjustments, but it really doesn't revolve around retirement that often, as far as I've seen.
Is there any difference when you get to like a late stage life, say someone's in their 90s? Is that a time when some, people really ratchet back on like their portfolios? They just want to make sure they have enough cash the rest of their life and not really worry about the market?
No, I haven't seen that very often. Again, what ends up, especially by the time you're 90, you've kind of figured out where you're at with risk and how you handle that risk. And if it's, I think one of my most aggressive clients, he's passed away now, but he was 93, and he was very, very aggressive his whole life. And it worked for him. Obviously, the markets were good during that period of time, but he had big downturns and he just kept going. And so, but that was his style. That's what he liked. It's how he lived. And I've got other people that are very conservative, and so anyway, it's more. Is your personality going to radically alter between the ages of 70 and 80 and 90? I haven't seen that to a certain degree. Should you be cutting back? Maybe, in terms of just the analytical side. But risk is really personality driven by far more than anything else. So if somebody's comfortable with what they've got, they generally stick with it for the long term. Matter of fact, we rarely see changes within the overall mixture. After 4, 5, 6 years of dealing with a new client, really getting to know and letting them really understand what they could lose and what they could make, what's the best year, what's the worst year, and they kind of get comfortable and they get an idea of what it is, and then they're kind of golden with that mixture eventually, and they might stick with it for the rest of their lives. I think that's probably the most common situation I've seen.
Interesting. So one last question, are municipal bonds worth having in your portfolio? And we see this quite often that some people like it and some people don't.
Yeah, yeah. Municipal bonds, of course, you get tax-free interest, which is fantastic. You can't use them in your IRA, so this would be for your taxable accounts. And so you have a choice in your taxable accounts for the bond portion of your portfolio. Do I have municipal bonds, which pay tax-free, or do I have taxable bonds, which pay a taxable interest rate? You can actually do the math to figure out which one's going to pay you the higher amount based on your tax bracket, because municipal bonds pay less, but again, depending on your bracket, you might actually net more after tax. And so high net worth people or high income people generally like municipal bonds because of that. I rarely use them in the portfolios. We have them, different situations and what have you. But again, I mean, I was just reviewing a case with a client last night. They had a 59% rate of return on the stock market portion of their portfolio over the last 3 years in total over that time, and a 9% rate of return in total on the bond market portion. And so, again, I believe that wealth is created from stocks and from real estate, right? For the most of us, right? And so what I'm trying to do with the bond portion of the portfolio is protect the stock portion of the portfolio. I want to protect that 59% piece. If I can set up a really good parachute for the bond portion and somebody takes on 10% more stock than they would have because they didn't have a good parachute, that's awesome to me because of the fact that, essentially they can make more money, in my opinion. And so one of the problems I have with municipal bonds is that they're not good parachutes. Go back to the big downturns and people are running into treasuries. They're not running into municipal bonds. 2008, people did not run to municipal bonds. Matter of fact, there were a lot of stories of different municipal bonds defaulting during that period of time. And obviously treasuries didn't default. So they didn't fall as much and did better as far as that goes. So you look at all the big downturns, people are not running to municipal bonds. And and again, I'm a little different. I'm not looking to maximize the rate of return on the bonds. I'm looking to use the bonds to protect the stock portion, and I'm trying to maximize the rate of return in the stock portion. I believe that's a better way to make money, and I believe that's actually happened in our portfolios over the long term also. So sometimes we don't do as well in the bonds as we might have if we're trying to maximize them. Buying a lot of high yield bonds, you could actually get some better rates of return. But a lot of high yield bonds dropped, over 20%, at least the ETFs, during the, downturn in 2020 when the market dropped 35. So that's a terrible parachute. So, they have a place in the portfolio, but they're not really part of the parachute portion for me. So anyway, that's just a personal preference. It's something I've learned over time. I have a belief that we make money in stocks and real estate, and that we want to try to maximize that. And by making a parachute portfolio out of the bonds, I can try to maximize the stocks and try to maximize what's happening there and increase wealth at a faster rate if things go right. So anyway, that's kind of my outlook as far as that goes. So anyway, that's what's happening today on our show. Again, I hope you got something from this and we're able to, look at this and say, hey, there's something I learned today that I can use to help improve my retirement. And that's our main objective. I really hope that happened for you today. And again, if you want to subscribe, hit the subscribe button with the little bell next to it. If you want to have an appointment, you can book that also right on our website. Hit the book appointment button. Love to talk to you too. And great time today. And thank you very much for coming, and look forward to seeing you next week. Thank you.